Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 225 of the Independent Advisors Podcast, where Mark McEvily and I, Matt Jessup, bring you everything you need to know from the past week in the world of the financial markets and financial planning. Our Director of Research and Trading, Nick Whitaker, is back on the show. Welcome back, Nikolai.
Always good to be here.
Love having you on. Mark is busy with other Jessup Wealth Management business-related items. So as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts and is as of November 1st. Mr. Whitaker?
Yeah, the S&P 500 is up 1.1% month-to-date and 10.4% year-to-date. The Dow Jones Industrial Average is up 0.7% month-to-date and 0.4% year-to-date, so about even. The NASDAQ Composite is up 1.6% month-to-date and 24.8% year-to-date, so very much leading the market.
Yep.
The iShares Russell 2000 ETF, think small caps, is up 0.6% month-to-date and down 5.1% year-to-date. The Vanguard FTSE All World ex-US ETF, think developed international, is up 1.0% month-to-date and 1.1% year-to-date. Again, pretty flat. Our yields, lots of discussion in the yield markets, which we're going to get into later in the podcast.
Yep.
The 3-month
listeners' viewers are going to love that.
Yep, the 3-month is currently sitting at 5.57. The 2-year is sitting at 4.95, and the 10-year is sitting at 4.77.
So my initial reaction, I said it in the podcast about 2-3 weeks ago, Nick, I want to say it again. I can't say it enough. If you went to sleep on January 1st and you just woke up and you see the return year to date for the S&P is 10.4%, makes it appear like a pretty easy year, doesn't it?
It does, yeah.
Right?
Yeah.
And
not the case.
It's been a fist fight.
Yeah,
you know,
not the case.
People got blisters on their hands.
Lots of up and down.
Lots of headwinds, lots of reasons not to be invested into equities all year. But look, S&P's up 10.4%.
And that's after a bit of a difficult couple of months, too.
Interesting, isn't it?
It is. Always.
You want to talk about some of the big headlines? You want to talk about the headline?
Yeah, sure. Just one major one for you today, because we are going to talk about the Treasury market, which has been in the headlines a little later. But the U.S. JOLTS reported job openings increased 56K to 9,553K in September, which is pretty good. It's the highest level since May. There were 1.5 available jobs per unemployed job seeker. Which is pretty solid. So do you have any follow-ups there?
Yeah, I mean, my initial reaction, and Jenna, our producer of the podcast, is going to think I'm a broken record on this, Nick. I mean, this is not bearish, right?
No.
You know, you got a lot of people who have been habitually calling for a recession, and the justification's pretty simple in their minds. There's no way the Fed can raise interest rates to the magnitude they did without causing a recession. Well, guess what's completely blowing up their thesis month after month after month?
Strong economy.
Strong economy. The data is just screaming strong.
Yeah.
And so, you know, at some point, if everybody in Wall Street continues to talk negatively, you know, perception at some point could become reality. But just based upon this data, you know, pre-COVID, we didn't have this many job openings.
No.
And so I just think it's just something that needs to be noted. And I would say sentiment of the market continues to be very negative. But if people just get their heads above water and start looking at some of the data, I don't know. It's a little stronger than people are giving it credit for.
It is. And we talked, I think Mark and I talked about that maybe a week or two ago. We dove into some Bloomberg articles about maybe why the data has remained strong despite these rate hikes, and get into that. And I still think, you know, it's printing money and giving money to the consumer, and then you add that with with the work from home, it has opened up a lot more job opportunities, which I think has helped the job market a lot. So,
Good way of saying it. I agree. For time management, Nick, are you okay if we start tweets, articles, and research from the week?
Yeah, absolutely. Let's jump into it.
Just for the record, I'm still going to call them tweets. I've come to the personal conclusion. I'm going to call them tweets for about the next year, and then I'll reevaluate in Q1 of 25. Is that fair?
That's
Jenna,
generally
is that fair for you? Okay, Jenna nodded. She's in agreement. So my first piece is a tweet from Charlie Bolello, and we're a big fan of Charlie's work. He does a lot of raw research. Mm-hmm. And so he had this post, Nick, on October 29th, and I'm going to verbalize it exactly. Quote, the S&P 500 is now down over 10% from its high in late July. That's the largest drawdown thus far in 2023. Is such a decline unusual? ? Not at all. A 10% intra-year drawdown has happened every 1.6 years on average. Jenna will put up this chart for our YouTube viewers. This will be in our show notes, Nick, and all of our social media sites, X, i.e. Twitter, LinkedIn, Facebook, Instagram, etc. What you're going to see here is it shows the intra-year declines of 1%, 5%, 10%, 15, 20, 25, 30, 40, and 50. And then what percentage of years going back to the original data set of the S&P 500 to 1928. And for that 10% correction, it happens 63% of all trading years. Okay, so let's call it a 2/3 chance. The reason I'm highlighting this is, guess what, listeners and viewers? What you've experienced from August to now and all the reasons for the corrections will be different. It could be geopolitics.
Yep.
It could be inflation data. It could be employment data. It could be consumer spending data. It could be corporate earnings data. Mm-hmm. We are going to have corrections. That is the price you pay for equity-like returns over time. Mm-hmm. And I know it's something that people don't like to hear, but you got to hear it. Yeah. And this is not abnormal. Yeah. That's what I wanted to point out. Nick, you want to add anything?
No, I think we talk about this a lot and remind listeners about this a lot and use different types of data to try to illustrate this point. But this is a pretty great way, a great statistic to think about it is, 63% of the time
we're going to have a 10% correction.
You're going to see the market fall 10% in a year.
Yeah. And 94% of the time, you're going to have an intra-year decline of at least 5%. So what that means is you buy a stock or you buy some sort of stock market indice like the S&P 500, there's a good chance you could immediately lose 5% of your money right off the bat.
Absolutely.
Right?
Yeah.
It's, again, without downside risk, there'd be no upside reward. And I just like to keep reminding our listeners and viewers that that trading activity is not abnormal.
The stock market's a long game.
It is, absolutely.
It's not for checking in on. For the average person who's not in the industry, I don't think you need to look at the market even monthly. Arguably, trust your advisors and trust your professionals, and just don't get over.
Follow your plans. What Mark always says.
Overexcited about the headlines and volatility, because it happens every year.
Happens all the time. So my second piece is the jobs market is still healthy. Now, I prepared this piece, Nick, before the job opening data came out. So this is a little different. So another underlying data point that points to no recession in the near future, in my opinion. This is a post, Nick, by Seth Golden. Seth posted this on October 30th. And he's showing this slide, and it says, layoff mentions across conference calls and news articles have continued to moderate. He goes, the unique mentions of layoffs in U.S. large cap conference calls, in Dow Jones news articles, and it shows the peak actually in Q1 of 2023. And since that is moderated. And again, I like looking at anecdotal data. Back in the podcast over the summer, I referenced the word recession that was mentioned during conference calls and U.S. large cap conference calls. AI did an analysis of this, and it showed recession was through the roof being mentioned in Q1 and Q2 of 2022.
Yeah.
And guess what we had in both of those quarters? Negative GDP growth. Now, the government wanted to change the way it interprets a recession. I'm old school, baby. 2 consecutive quarters of negative GDP growth. You can paint it the picture however you want. That's a recession.
Yeah.
And the data backed it up. Well, you're now seeing more real-time data on layoffs. That stuff peaked being talked about and mentioned in news articles and conference calls Q1 2023. I look at that, and that's not a bearish data point.
No, not at all. And this type of data is really great. FactSet pulls a lot of this type of data together. There are other Bloomberg. There are other research.
The one from over the summer was FactSet, for the record.
Yeah, I see it most with FactSet, but I've also just spent a lot of time with the FactSet database, so I'm more familiar with it. So I've spent years seeing that data and kind of understanding it. But it's important because what the data does is it pulls from conference calls from the CEOs, the CFOs, the COOs of the biggest, most important companies in arguably most important companies in the world and in the U.S. who are dominating the earnings cycle and job growth and job decline.
Well said.
And so
well said.
You're hearing it straight
from the
horse's mouth, so to speak. Another time that we've used this and talked about it in the podcast was the supply chain. Very similar charts where you saw the supply chain. Everyone was talking about that and how that was impacting their business, and you saw that chart go up and you saw it come back down. So it's good data, and it's very telling to see what's on the top of the minds of the biggest C-suites in the world.
It is, and I remember back to Q1 as I think back now. There was a lot of layoffs in, say, the financial services sector in the first quarter earlier this year. And guess what that coincided with? That banking crisis in March.
Yeah.
Right?
And then there was a pickup in big tech, and you saw some layoffs there.
Over the summer.
Not crazy amounts, obviously, because you look at the underlying data of the underlying econ jobs data, and it clearly wasn't enough to make those numbers just drop through the floor, but there was articles about it. Still are. I think I saw something this week or last week about another big company who's trimming some jobs, but nothing like
of large magnitude.
Right. Not like we're cutting 50% of.
Yeah, I don't think it equals with the sentiment that I'm feeling still in the marketplace. I'll put it that way.
Yeah.
Good way of saying it. Mm-hmm. So my third thing is going to take us to a tad bit longer. This is a blog post by Brad McMillian on October 27th. Brad McMillian is the Chief Investment Officer for Commonwealth Financial Network. Brad and his team do oversee a lot of money, literally billions, in portfolio strategy. I respect Brad. He is a smart cookie. I crossed paths with him when I was on Bloomberg a couple of weeks ago, and as I'm talking on Bloomberg, I can see out of the corner of my eye and to the right, Brad McMillian's up next. And I'm like, all right, not only do I have the Bloomberg crowd listening to me, I got Brad McMillian staring at me right here. A little nerve-wracking.
Yeah.
So I'll share this with everyone. I want to read this, Nick. It's going to take me maybe 2 minutes, but I think Brad does a good job summarizing what's been happening over the past month. You ready?
I'm ready.
Here we go. October 27th, Brad McMillian, quote, "This week was about the markets, which kept dropping, even as economic news continued to be good. Growth last quarter was well above expectations at almost 5%, and personal spending increased for the 6th month in a row. Not bearish, Jenna. Despite that good news, markets pulled back again, with the S&P 500 looking like it will slide into a correction that is defined as 10%, down more than 10% from the most recent peak in August." He finished that for me. His next topic, side effect of economic growth. "On the face of it, that decline doesn't seem to make much sense. But the unfortunate side effect of economic growth is that interest rates are likely to stay higher for longer. and that is just what the markets have started to realize. Interest rates stayed at almost 5% for the 10-year U.S. Treasury all this week. And last, as markets priced in higher for longer, in turn, stock market valuations, which move in opposite directions of rates, dropped from around 20 times next year's earnings to around 18 times. That's a big shift and explains the stock market pullback. What's next? What does this mean going forward? The good news is that at least for the moment, rates seem to have stabilized, which should limit any further valuation declines in the short term. Over the long term, the valuation adjustment should be offset by earnings growth, which is still expected to be strong over the next several quarters. With the economy still healthy and earnings expectations to grow, the current repricing looks like an adjustment rather than something worse. No one likes a market pullback, but with a solid economic foundation in place, we have some cushion here. The current decline at around 10% is quite normal. In fact, it's something we typically see around once a year. Even if it gets somewhat worse, that would be normal and something we would have seen many times before. Last comment, this is normal. In other words, while there wasn't a great week for the markets, this is a normal pullback that makes sense given financial conditions. From what we see right now, prospects for the market over time are still positive, and that is a good thing to remember as we finish the week. Have a great weekend. Pinned, Brad McMillian. I agree.
I think it's extremely well said and an excellent recap on what's going on with the market and the bond market and the reason for the pullback. It's uncertainty, which we're going to talk about a little bit with the Treasury market. Mm-hmm. And anytime you have uncertainty in the market,
market has to price that in.
The market has to price that in, and you see movement in assets. It might be bonds, it might be international, it might be domestic, it might be everything. It might be profit taking off of some of the names that were decent.
Yeah, that
right?
held the market up.
That held the market up. So, and I think the point that jumps out to me that I'm seeing more and more, and I'm hearing really smart, sharp professionals talking about more and more is this idea that the market is starting to accept this higher for longer and maybe accepting that rates aren't going to go back down. We're not going to go back down to the post 2008 bottom of the barrel interest rates where money is free anytime soon. And we're basically getting back to what was the old normal.
Yes.
Prior to 2008, which I would argue is an excellent thing for life in general. Is an old normal because, 0% interest rates and look across the seas over at Japan, negative interest rates. I would argue that I don't see how that plays out well in the long run.
I'm with you on this.
Of life.
Yeah, I mean, again, I said this so many times in the podcast, in a interest rate environment that we're in doesn't automatically spell doom for risk assets. It's rising inflation that tends to cause doom for risk assets. And I'm not seeing that in the inflationary data. Right. The market and the economy can do just fine in a 4, 5, 6% interest rate environment. That's not the kicker. That's not the killer for it either.
Right. Yeah, and I think it's and that's what Brad mentioned is accepting this higher for longer. I think it's taken the market a while to really accept it, and now that we've seen this econ data month over month over the past 6 months come in, and earnings is still strong. And
good point, because people are scratching their heads. Wait a minute, how can the economy be like this with interest rates where they're at?
And so you see this repricing, and then Brad makes an excellent point. Okay, we repriced the valuations back down. Where are the valuations the highest? The valuations are highest and some of the high-flying names that really led the market higher, right? Where do you see some of the weakness over the past 3 months? Okay, some of those same names that led the market higher, who also have higher valuations, who are also, one could argue some of those names that led the market higher are a little bit more interest rate sensitive. We could argue about that all day.
Sure.
But it makes a lot of sense. I think he
did a good job.
He nailed it. Yeah.
Turn it over to you, Nick. What do you got this week?
I have two pieces, and the first piece is it's a capital flows analysis from IHS Markit, or from, I should say, S&P Global Market Intelligence. IHS Markit was bought by S&P Global a couple years ago. But this is research I'm very familiar with because the person who put this out, I used to work with him.
That is awesome. Yeah, that's awesome. I knew you used to be associated with IHS Markit.
Yeah, so I've seen the inside of this report. I've seen the back end of the data. So it's something I understand.
You actually know how the soup is made.
I know how the soup is made. Yeah, it's a pretty cool set of data and very unique. There are two charts that we'll throw up here, and one is the 6-month cumulative capital flows across different types of investors, institutions, hedge funds, retail, and index or ETF, and then it just charts the S&P 500 there. I'm going to explain what those 4 categories are quickly. Institutional money is the big money, the big billion-dollar long-only investors. Think the Capital Group, which are American funds that listeners will be aware of, those mutual funds, that group, it's $900 billion institutional money investor. T. Rowe Price, another one. Fidelity. There are a lot of them out there, but the institutional money is the big billion-dollar. They're the behemoths on Wall Street. They're the ones that really, the issuers, C-suites, they want to work with institutional money because they're typically long only, i.e. they're not shorting the stock, they're running mutual funds, et cetera.
Yep.
That's institutional money, the big boys.
Got it.
Hedge funds they can be large, they can be really small. They tend to be market neutral, get a lot of news coverage, right? They're the guys who are think Gordon
Gekko from back in the day,
right? Or like the Big Short, right?
Yep.
Some of those guys were hedge funds, so those
Carl
Icahn, Bill Ackman, and those are some of the big ones. You might have heard of like Renaissance Technology. So you'll have like quants that are fully passive strategies that are hedge funds. So a lot of volatilities. A lot of hedge funds blow up every year because they have such aggressive strategies. When I say blow up, I mean they like
lose all client money.
Yeah, lose everything, and they have to go find new jobs. There are some very successful long-term hedge funds, but anyway, that's like fast money. Think of that as like fast money.
Yep.
Retail is retail.
Retail investors, individual investors.
Mom and pop buying a share of Apple on their Vanguard account or whatever. That's retail. And then index or ETF is passive money. So i.e. A strategy, an ETF that you would buy that's tracking the S&P 500. So like an SPY is essentially just a proxy. It's an ETF of the market of the S&P 500. And so that's index money. So they're not trying to be, they're just following the market. And so that's passive money. So that's a breakdown of what those few different categories are. And the way that this report is put together is with IHS Markit's basically insider data. So their clients are publicly traded stocks. So they see custodial data behind this. And so this cumulative flow over the past 6 months, you can see institutions, the big money, the big boys at the table. You see
they've been net sellers.
They've been net sellers. Hedge funds are kind of back and forth. Retail has been picking up a little bit on the net selling, and index or ETF has been increasing. What's particularly interesting to me is kind of the continued decline in the second half here. One thing we used to talk about back in this industry is whenever you have your long only, your big institution, as an issuer, when I say an issuer, think like a stock, like the people who work behind the scenes of the stock, like the CEO of XYZ, right?
Yep.
As a CEO of XYZ, you want the institutional money buying your stock because they can help push the price higher because they're actively managed and they have a ton of money and they can push it higher. What you don't want to see is what's on this chart. You don't want to see long money only going lower and index money going higher because index ETFs, they're passive, so they don't push the bids, they just accept it.
Yep.
So this is one of the reasons I think that we've seen some of the pressure in the market over the past three months.
Yes.
In my opinion. If there's another chart that we'll throw up here, and this is just from September, so you can see the flows, and this is just institutional capital, the flows by sector in September. A little bit of stale data, of course, but that's how this industry works. There's just a delay in the data. And you can see that there were net sellers across pretty much everything except utilities, which is a defensive, more risk-off trade.
Yes.
And so just a quick comment on the data and why I like it. And it's not perfect. No data set is perfect when it comes to this kind of thing. But it's basically IHS will take all of their clients, and they have most of the S&P 500 as clients, and they see their custodial data. Yeah. And then this business has been around for decades, and they've learned and tracked and studied this data. I know it very well. And so they're basically just studying the flows of these different custodians that are where hey, this custodian is typically an institutional custodian. This custodian is typically a hedge fund custodian. And they can track that over time, and they basically take all of their clients. There's probably close to 1,000 by now if I was guessing, but when I was there, it was around 800. And they put all this data together so they can create these charts. So that's pretty cool. It's pretty cool data, and it's actually very unique. You don't see it anywhere. You see it from some of the banks, but
not this way.
I would even argue that this data is better than some of the data that you would see from like a Goldman Sachs or a Morgan Stanley, which is probably a hot take, but
I'll take the hot take. I'll take a hot take on a Thursday. You know what my initial reaction is on this also? Mm-hmm. When I see this institutional flows going negative, people have to remember that these large institutions cannot turn on a dime.
Oh, not at all.
So let's assume for a second, because everybody on Wall Street, for the most part right now, is a grumpy Gus, and they're very pessimistic. At some point, and this could take a long time, but at some point, if they want to be risk on, that's not going to be a 1 day, 1 week, 2 week phenomenon.
No, not at all.
It's like turning a cruise ship. Mm-hmm. It's going to take some time.
It's like turning an oil tanker.
Yes.
Yeah.
It's going to take a while.
Yeah.
And my biggest point is Wall Street, for the most part, has been underweight equities since the middle of last year.
Yeah.
And at the top of the podcast, we just talked about it being a challenging year, but the S&P being up 10%. Talked about the NASDAQ being up over 20. I'm just going to throw it out there. A lot of money managers are underweight equities, and they're missing out on these returns. Mm-hmm. And at a certain point, you got to throw the towel in and realize that the underlying economic data is stronger than your sentiment and attitude is towards the market. Mm-hmm. And at some point, you got to follow the data and not what your sentiment is telling you.
Yeah. I want to explain that to listeners when we say these big institutional behemoths, they can't turn on a dime, and just make sure people understand
Do
that. Again, these are billion-dollar portfolios, multi-billion-dollar names. There's only so much liquidity in a single stock.
Correct.
And so let's say a billion-dollar investor wants a 5% exposure to XYZ.
Yep.
It's going to take a billion-dollar investor a lot longer to acquire 5% with the liquidity at hand. They're not going to be able in 1 day to go out and buy all the shares they need to gain a 5% access to for their clients.
Yeah, but you take like Fidelity Contra, the largest actively traded mutual fund in North America, 130 billion of assets. Yeah. It's run by a single guy, Bill Danoff.
Yeah.
If Bill wants to buy something, okay, and it's a mid-cap name.
Yeah, like initiate like a 3-4% exposure or something like that.
I mean, if he does it too quick, he'll completely move the market in that stock.
Yeah, and that's what I was talking about driving the price of the stock, driving the bids. Yeah,
he'll literally move it.
And so getting in and out of those names for long-only money, it takes, like you said, weeks and months, because you don't want to push the price too much.
You want to hide your footprint to the best of your ability.
Right. And that's why I see C-suites like long-only money, because it's slower. They're talking to these investors. It's consistent. They're not going to turn on a dime, as opposed to a hedge fund
just dump it in 1 day.
Right, who will have complex strategies and are typically smaller, so they can move quicker. So I just wanted to make sure.
We're preaching and sharing knowledge.
The last piece I have is I just thought we could open it up for a bit of a discussion on Treasury refunding in the bond market. I saw this popping up in the news over the past week. It was in the news a lot yesterday. And so I just thought we could kind of break this down and debunk why is this in the news, explain what it is, talk about the bond market, what's going on. And I think Brad McMillian hit the nail on the head as to the big picture, which goes back to uncertainty. But I want to start with just kind of talking about like what is Treasury refunding.
All right, this is what I say. Okay, students, on video and podcast, this is where you listen up. Nick's about to preach.
Oh yeah. Sorry in advance.
I love this.
for
These are what we
preaching.
call teachable moments.
Yeah. This is a bit of a let's all learn together.
Yes, learn together
in real time with real data. And
Professor Whitaker is up.
Yeah. Professor Whitaker to the mic. So Treasury funding is just when the Treasury announces changes in their debt management policy. It typically comes in the middle of the quarter, 2 weeks prior to like a bonds expiring. So in layman's terms, it's basically when the Treasury Department comes out and says how much aggregate debt they're going to refund from the bonds that are maturing, as well as if they're seeking additional debt, or if they're saying, hey, we actually don't need as much debt. So let's say, hypothetically speaking, I'm just going to throw out really broad numbers here. The Treasury has $100 million of notes. It's much higher in reality. $100 million of notes expiring, maturing, and they go out to the market and they say, all right, we're going to refund that. We actually need to borrow another $100 million, but we're also going to issue another $10 million in excess. So
Yes.
that's extra
Yep.
bonds that they're issuing to the market.
Yep.
And
we still need to borrow that 100 that's coming due, so we're going to sell another bond because we still need that 100 million.
Right.
And in addition, guess what? In your example, we need another 10 million on top of that.
Yeah, we need another 10 million because Congress just passed this bill. We need some more money. The Treasury is running the government, right? The Treasury helps fund everything that you hear about on Wall Street.
That's right.
Federal jobs, et cetera, programs, big programs.
Social
big
spending,
spending,
Social Security, Medicare, Medicaid.
et cetera. And so that's what Treasury refunding is. The next big piece I want to talk about here is why has the market and the media picked up on this recently? and the reason I bring that up is because I've been in the market long enough to understand cycles and know kind of, all right, what typically comes up. And Treasury refunding is not something that I see coming up on CNBC headlines that often, because the Treasury auction, that's what it calls a Treasury auction.
They're usually very boring.
Extremely boring.
It's like watching paint dry usually.
It is very much like that. And so that's one of the reasons I wanted us to talk about this, is just to explain to listeners why. Why is all of a sudden CNBC reporting on the Treasury refunding? You just don't see it that often. And the reason there's CNBC, I read an article yesterday that they gave like one reason why. I saw another article that gave like one reason why. It's not one reason. It's never one. In my opinion, it's never one reason. The markets are extremely complex. There's multiple narratives. There's multiple participants doing multiple different things, right? There's so many moving pieces. There's not one reason. Debt deficits and bond yields are on the rise. And so the market is looking for reasons for that. Like, hey, what's going on with the yield curve? What's going on with the debt? What's going on with the Treasury?
In plain English, the government is spending more money than it's taking in revenue, and it's taking on additional debt, and the Treasury is tasked with raising that money.
Right. In a higher rate environment.
That's right.
Right.
So their old bonds come and due, and they paid that, let's say, at a 2% rate, and then they got to roll it because they still need to borrow the money. Now they're paying 5 or 6%.
Exactly, which means the Treasury now has a higher interest rate cost.
Carry cost.
Carry cost,
Yeah.
exactly. So it's more expensive for the government to finance their debt, the
There it is.
Treasury, right? So the reason that this topic has come up in the markets or in the media It's a combination of concerns about the deficit, which we just spoke about, supply and demand dynamics, which I can go into a little bit, geopolitics, concerns about global investors. There's risks there,
Yep.
right? You could go at length about geopolitics. How involved are we going to get? Is that going to bump up our spending?
Absolutely.
How does it impact global investors who typically buy treasuries for their own safe haven for whatever reason? How does that impact the supply-demand balance there? And then lastly, I would say it's concerns about stronger growth. And going back to what Brad McMillian said, if we have stronger growth, then that means the rates are here to last longer. If the rates are here to last longer and the Treasury is going to have to borrow more money at higher rates
to fund its deficit spending.
To fund its deficit spending, how does that impact all of this? So those are kind of the few different narratives that are really driving why this was
such front and center in the news.
Prevalent in the news. So I'm gonna skip to the end, and then we can come back and talk a little bit about the middle. But What happened with the Treasury funding announcement? The market liked what it heard. The Treasury came out and the bulk of the additional borrowing. First off, the additional borrowing, they refunded everything, and then they added an additional, I think it was like 10, 12 million or something like that, or billion. But it wasn't as much as the market was fearing of. The market was fearful that the Treasury was going to come out and just blow way past the refunding.
And just ask for a bunch of money
and ask
from the
for
market.
way more money. And that was going to stress the bond market out. It was going to stress bond investors out. It was going to stress equity investors out. You would have seen a big reaction, and stocks probably would have moved lower if that would have happened.
Sure.
That did not happen. The Treasury came out, was very calm and collected, as we expect our economists to be.
Yes.
And they refunded the additional amount, had a little bit of additional borrowing. And the key is that most of the additional borrowing is going to be in that 2 to 5 year end, as opposed to the 7 to 30 year end. And I think that gave the market a little bit of, okay, cool, that's fine, 2 to 5 years, we can hang with that.
That's right. They don't want to overload the long end of the curve.
Exactly. And this is the perfect example of the learning moment. Can you explain that? They don't want to overload the long end of the curve. Can you explain that to listeners?
Yeah. So what I mean by that is they don't want to be borrowing money from investors with a long-dated maturity. So they don't want to go out and be borrowing money and asking people, hey, instead of me borrowing this money for 6 months or 2 years, I want to borrow this money and I'll pay you back in 10 years, in 30 years. Mm-hmm. And when you start to see the government going out that far, the concern for the market is, well, wow, if you're locking in longer rated maturities, you must think, U.S. government, that rates are either going to stay where they're at or actually move higher. Whereas if you're staying on the short end of the curve, shorter term maturities, U.S. government, that's you telling us that you think rates are going to come down. So you're not going to be trying to borrow a bunch of money and lock it in for a long period of time.
Exactly.
So the market wants to see the government overloading the short end of maturities, the short end of the curve, because it's telling the market, we think rates are going to come in. It's like someone having a mortgage. You love having a low interest rate on your mortgage. This is why people aren't moving right now. Mm-hmm. People aren't moving because they got a sub 4% interest rate on their mortgage.
Yep. Why
are you going to go out and get one at 8%? Right? Unless you really, really have to.
Exactly.
And the government right now is sending a message, hey, we're going to stay on the short end of the curve because what they're telling me as an investor, we think rates are going to come down over the coming years. Mm-hmm. That's going to save us some money.
Right. And so going back to why that was perfect, exactly what listeners needed to hear, by the way. Couldn't have said it better. I don't think anyone could have. That was perfect.
Thank you, sir.
That was a perfect description. And then going back to, okay, why is it in the headlines? All right, we knew what was going to happen with rates. The market was very confident that, because the rate hike was yesterday too. So we knew that the Fed isn't going to hike. We're not going to do anything. But this was really going to give the market an idea of
the psychology and a mindset
of where
of the government
we are,
or what they think about interest rates.
Exactly, because the yield curve right now it has been the long end has been drifting up a little bit, mm-hmm. and is flattening out. And whenever you have that flattening, It's a good sign that there's a lot of uncertainty in the market, uncertainty around the economic conditions, uncertainty which way it's going to go, which is why when you have times of uncertainty in the bond market, where are we going to look? Going to look to the people who are shelling out the supply and the demand, right? Hypothetically speaking.
Yeah.
I think that covers it. I don't need to go too much into the weeds here. I have some more, but is there anything else you wanted to kind of discuss
On this specific topic?
On this specific topic, anything else?
I guess my last comment is that the market goes through different obsessions in different time periods. And an obsession right now is how much debt the government continues to take on with deficit spending. And this is going to come front and center over the coming months as, in my opinion, we're going to have a government shutdown. Mm-hmm. Let's just plainly say it. The U.S. government continues to spend money it doesn't have, and they are borrowing to come up with that difference. As the economy,
from the Treasury market.
Yes.
And full circle for people who are really learning.
And as the economy is growing, the market is less concerned. But if you start to have a slower growth economy, interest rates are high, they're paying a lot to service the debt. That's where the market becomes fixated on, oh my gosh, at a certain point, the government can't keep doing this. Now, I've heard this my entire career, okay? 24 years in the financial services business. What is the constant narrative? We can't keep taking on this debt. And my reply constantly is, look around the world, people. Our debt to GDP is nowhere near where some of these other nations are at. And I got news for you. You might not want to hear this. We can take on a lot more debt. Now, I'm not saying we should.
Right.
There's a difference between should we and can we.
Yeah, absolutely.
But
an excellent point.
There's a lot more borrowing the government can do, and I hate to say that.
Yeah. I think that's well said. And that's why it's been in the news, and that's why you've seen some fluctuation in yields, and yields went back down yesterday. So yesterday was very smooth. Everything the market wanted.
Market action got me going.
And that's because
ironically,
because of the Treasury market.
My goodness, yesterday was just steak dinner, baby.
Right, and that's because the yields went down following the Treasury announcement. I mean, the market got
all the
what
fixins,
it wanted.
Loaded baked potato.
It did, absolutely. Mac and cheese,
Get some truffle in that?
Absolutely, yeah.
Okay, I'm in.
Lobster mac and cheese.
Lobster mac and cheese.
Yeah.
Jenna, we're painting the picture over here.
Yeah, so yesterday was a good day for what the market wanted to hear. So hopefully that helps listeners. I'm not going to go too much more in the weeds here. I think that's probably enough.
No, that's great.
A digestible amount.
Well, we'll skip the financial planning topic of the week, because I think we've already, Professor Whitaker was on deck today.
I got on my soapbox, so.
Very well done. Very, very well done.
Hopefully.
Well, I do want to do a quick promotion here for Blueberry. So if you're interested in starting your own podcast, you can get your first month of Blueberry podcasting hosting for free with the promo code Jessup Wealth. That's all lowercase, no spaces, Jessup Wealth. Use the hosting estimator on their site to determine the best plan for you. And don't forget, that's Jessup Wealth for your first month free. So Nick, it's November 2nd. The year's 2023. We don't have any listener questions this week. Anything you want to leave our listeners and viewers off with? Your final Professor Whitaker words of wisdom.
A lot of pressure on that. Final Professor Whitaker words of wisdom. I don't have a lot on top of what I've said. There's uncertainty with the yield curve and rates. This is the kind of market we're in. We've been talking about it for months. Don't panic. Don't let CNBC stress you out.
I like that.
It will be okay.
I like that. My words of wisdom. I know Mark and you talked about it on the podcast last week. The market very rarely is down 4 months in a row. And the market was down in August, September, and October. And when I look at sentiment levels, I look at technical levels on the market, like the 50-day, 200-day moving average, 10-day. I look at equity exposure levels. Things were screaming to me over the past week of extreme oversold conditions on a short-term basis. So this is by no means guaranteed. But my strong opinion is we're going to get a rally into year end. And this, based upon the data I'm seeing, personal opinion personally, I would not be underweight risk assets right now. But that's just my opinion. If you have a proper long-term time horizon, you're invested in line with your risk tolerances, goals, and objectives. My compliance side comes out.
Yeah.
But
as long as all those boxes are checked.
Yeah. I mean, if you got a longer-term time horizon, you want to be buying stocks when they're on sale. You want to be buying them when there's blood in the streets. And I'm just going to throw it out there, Nick. There was blood in the streets over the past couple of weeks.
Yeah, absolutely.
Okay? People were concerned. Yeah. I'm seeing fear. Mm-hmm. And the 10% correction, people are simulating it. It's like, okay, well, the market just recovered in May, June, July, and that's it. Mm-hmm. I don't think it's it. So that's where I'll leave our listeners off. So thank you for joining us for episode 225 of the Independent Advisors Podcast. Myself, Nick Whitaker, Jenna, Mark, we hope you have a good rest of your week. Nick, thank you for being our guest here this week, and we'll see everyone soon.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.